Good evening, everyone. My name is Harkiran Sehgal. I'm the manager for LLM admissions at Jindal Global Law School. Today, we have with us Professor Kumar Paramjeet Singh. He's an associate professor with OP Jindal Global University and is associate dean and associate director at CPGLS Center for Postgraduate Legal Studies and Center for Global Corporate and Financial Policy at JGLS. He specializes in corporate governance, corporate finance, and labor relations and teaches courses on corporate labor and employment laws at JGLS. About his experience, Professor Singh has a wealth of experience working as a legal consultant at various law firms and has litigated in Supreme Court at New Delhi. Prior to joining JGLS, he was working as a corporate lawyer with Fox Mandal and Company, and he was part of corporate law team. He has also delivered an international credited course for the China University of Political Science and Law at Beijing, China. Professor Singh holds his BSL LLB degree from Symbiosis Law School, Pune, and thereafter he was admitted to the Bar Council of Delhi as an advocate. He is fellow at Institute of Directors India. He is a qualified company secretary and is a fellow member of Institute of Company Secretaries of India. And he often visits the institute as a guest speaker. He holds a Master of Laws in European Legal Practices from University de Rouen, France, and University de Católica Portuguesa, Portugal, under the prestigious Erasmus Scholarship of the European Commission. Without any further delay, I would now like to request Professor Singh to start with today's topic for the webinar, which is securities regulations in India.
Thank you very much, Harkiran, for the quick intro. So without wasting time, we have already started late. So let's start the topic, securities law. So the basic idea was to get yourself acquainted with the basic facts about securities market. Our securities market is very, very old. It has started in 19th century, in early 19th century, 1800 something. And BSE, it's one of the oldest stock exchange in India. And our securities market, especially after 1991, it is growing at a fast pace. Equity market capitalization just of NSE, National Stock Exchange, it has crossed 9.4 trillion US dollar. And I feel that, this subject should be taught. All the students, law students, especially specializing in corporate law, they should have some understanding of securities market, what it is, and all. So securities market, of course, I dedicate 2 semesters in teaching about securities market and securities regulations, and this session would be for 40 minutes, 45 minutes at max. So I have chosen to, just impart some basic knowledge to the student, which might be very, very helpful. And at the same time, they would understand how it functions, what are the participants, and what are some of the rules and regulations of the securities market. So very quickly, I will say, in Indian financial market, basically it is divided into 2 parts. First part is money market, and the second part is capital market. A big portion of capital market is the security market, how we understand security market. So when I say securities market, most of the students and the people, they get the idea that securities market, basically it is, it is simply the stock market, the stock exchanges like BSE, NSE, and all that. But let us understand that securities market, it is divided into 2 parts. First is primary market and second is secondary market. Primary market is also called as, since the investment comes in the new form, securities are first of all issued in the primary market, and then it is traded and it is dealt on the secondary market. So primary market, it is also called as NIM market, new issue market. So all the issuance of the security, IPOs basically, or FPOs, it happens in primary market and not secondary market. Secondary market is just for dealing in the securities. Nothing more happens there. So securities are issued. It will be issued by the company in the primary market. And once it is issued in the primary market, it would be dealt in the secondary market. When I say primary market, there is no physical location of primary market. It is just like everything happens like in a very, in a vacuum manner, in a vacuum existence. So unlike secondary market, which is visible, and that's why most of the people think that we can see BSE, we can see national stock exchanges. So BSE and NSE, they have a physical existence. So, Dalal Street, most of us, we understand what Dalal Street is, and we understand like there are different stock exchanges. So some of the, as of India, there are approximately 7 to 8 stock exchanges which are recognized. A few years ago, I mean 6, 7 years ago, we had 22 to 24 stock exchanges, but most of them, they are de-recognized now. They are not a recognized stock exchange, and they cannot function as stock exchange. So as of now in India, we have stock exchanges which functions primarily in equity, debt segment, derivative segments, and commodity segments. Mostly, these are four areas. Of course, this could further be bifurcated into lot many other parts. So let us understand what really it means to be the primary market and secondary market, because most of the IPOs, it would come in the primary market. So we are waiting for LIC IPO. We have seen a Zomato IPO. We have seen Nika IPO. So IPO happens in the primary market. I will tell you the difference and the similarity, so you will understand the context. So let us understand the differences first. First difference is new versus old securities. So as I have told, that primary market is also called as new issuance market, new issue market. Here, the securities issued are new. It is issued for the first time. It is issued for the first time. So we understand the concept of IPO, initial public offering. Initial public offering means that company either has gone for the issuance, company issued the security either for the first time. Earlier it was private limited company, it has converted into public limited company, and then it went for the issuance of the security. Or it was a public limited company, but it has never gone to the public. It was a purely closed public limited company. So it was purely closed public limited company. All the shareholder, they were known. Mostly they are like 7 in number, which is a minimum requirement for a public limited company. So for the first time, they have chosen to go to the public, truly to the public, and that's what public limited company does. So when they go to the public for the first time, and especially through the stock exchange mechanism, this process is called as initial public offering, right? Of course, public limited company, they could go to the public. There are so many ways, and stock exchanges, it is one of the ways, most popular one though, but it is just one of the ways to approach public. But we understand that it is the most important one. And in one go, we can directly go touch, we can knock to the door of a lot of investors in thousands and in lakhs. This is exactly what we are expecting in LIC IPO. Lakhs of the people, they would come to the market maybe for the first time, and most of the people, investors, they are lined up. So basically, when you go to the public, especially for the first time through the stock exchange mechanism, then it is called as IPO. IPO happens in the primary market. Now, secondary, old security, because we were talking about differences. Old securities are security which has already been issued, but now it needs to be dealt in, right? So say, for example, I sell the security to Harkiran, or our IT team would purchase the security from Harkiran. So we are basically, purchasing the security or selling the security, or we could deal in the security in so many other ways. So this dealing in the security, purchase, sales, or other ways, dealing with the security, it would happen in the stock market. And that is why all of us, we understand stock market. That's the place where we go and we purchase the security and we sell the security. As I have mentioned that there is a physical location. So BSE and NSE and all the other stock exchanges, they're physical location. They would be located somewhere. But now we don't need to trade actually by going there. So earlier it was a place where auction would happen. I think most of you have seen 1992 scam, and you have seen how Harshad Mehta has started, the whole journey. There was this auction ring, and people would be shouting like this shares at this price, and whoever wished to purchase the security, they would auction, and they would, at that price, they would purchase the security or sell the security. But now this concept is not that much of relevant. It doesn't hold that much of relevance, because everything is automatic, everything is digital. Why someone would take the pain of going to BSE or NSE or other stock exchange, commodities stock exchange, and do it? Whereas we could simply purchase the security by press of a button. We could sell the securities by press of a button if we have trading account with the broker or sub broker, and we have depository account, because depository is also necessary. We'll discuss about both the concepts, right? So if you have these two accounts, and if you have like a bank account aligned with it, 3 accounts, basically, you can trade in the security. Money would be debited or credited from your bank account. It depends whether you are purchasing the security or selling the security, or the securities would be debited or credited in your depository participant's account. It depends on whether you are selling the security. If you sell the security, so it would be debit. If you purchase the security, it would be credit, right? This is how it functions. So old securities, security which has already been issued to someone, it could be traded on the stock exchange. right? But when it is issued for the first time in the market, it has seen the light of the day for the first time, then it would be in the primary market, new market. There are other kind of securities also. I hope, like you, all of you, you have heard about FPO. In popular parlance, we call it further public offering, or in America, we call it follow-up on public offering. Anyway, FPO, right? So FPO also, that's another chunk. But it has been issued for the first time. So, say for example, authorized share capital. Say for example, it is 1 lakh shares. If you have already issued 60 or 70,000 shares, then you have like possibility to go up till 1 lakh shares, right? So company has an option to again issue 30,000 or 40,000 shares in the market. Again, that share will be issued for the first time as a fresh share. So if it is issued for the first time as a fresh share, then again it will be called as, it will touch the primary market itself and not secondary market. So basically what I'm saying is, in the primary market, issuer company issues the security. So the investor, they deal directly with the issuer company, right? They would deal directly with the issuer company. They would purchase the security from the issuer company. Of course, you cannot sell the securities to the issuer company. So primary market, this is one-way traffic wherein you purchase the security directly from the issuer company through a chain of intermediaries. I will come to this part subsequently. Now, secondary market is where you do not directly deal with the company. You purchase the security from someone who already holds the security, right? So that is secondary market. Second difference is nature of financing. Nature of financing means, the money, what you are paying, for what purpose it could be used, and for who could utilize it, who could use it. So in the primary market, the amount you pay, that amount directly goes to the company. That amount directly goes to the company. Say, for example, share price is 100 rupees and the premium is 27 rupees. The total cost is 127 rupees per share. 27 rupees will go in the security premium account, and 100 rupees, it would go to the capital account of the company. But the whole amount, 127, it would go in the balance sheet of a particular company that is issuer company, right? No one else could, take it. So whenever company needs money, either for expansion or venturing into new domain, new area, new sector, or coming up with a new product line, or if they require the money for any project whatsoever, then in that case, they would like to come to the market. It's not like every company could come to the market. There are a lot of conditionalities mentioned under ICDR regulations. If you fulfill it, then in that case, you could come to the market, you could get the money, you could utilize the money for different purposes, for different projects, right? So you need the money, and that money, and the money what is needed by the company, it could come through the stock market itself. Not stock market, but primary market, right? The stock market is generally used, it is related to the secondary market. Now, uh, there are a lot of options a company could get the money, right? So if they need money, it's also called as funding, because it's funding of operation, or funding which is required for certain project. So company requires money, and that is why they are going somewhere. They could go to financial institutions, they could go to the banking institution, they could go to the lending institutions, but their beauty to the equity, right? The most important thing is, you don't need to pay the dividend. Dividend is not mandatory unless it is declared. So if it is proposed by the board of directors, if it is accepted in the general meeting, then it becomes a dead due. But till that time, it doesn't matter if the company earns a lot of money, they may choose not to declare the dividend. So if the company is in growing phase, and if they need money, and if they want to claw back the profit which is generated over a period of time in the company itself and not pay any return, this is a clear possibility. I'm not saying that it exactly what happens, but there are companies who do not pay dividend, but then also investors are more than eager to invest in such kind of companies. But at the same time, there are market expectation, and under the market expectation, or you can say market pressure, there are a lot of companies who would make the payment, interim dividend, even annual dividend, and all that. Right. So financing is the money. They needed money, they needed financing, and this is one of the best financing mechanism, in lieu of which they need to, waive off some of the control over the company, right? Because with equity comes the ownership, voting right, right? So promoter, earlier they had 100% maybe, stake in the company. Now their stake would be diluted. So the Securities Contract Regulation Act, it says that at least 25% shareholding, it should belong to the public. And then like ICDR, it also determines certain percentage should be given to qualified institutional buyers, certain percentage to to the public, and certain percentage would belong to the promoters group. So promoters group would not have that much of control now, because they have they have gone truly public, and literally member of the public, they are part of that company as an owner, right? And it is a democratic process. I'm not going into that. Democratic process means vote would be by the majority, right? So the point to be noted here is it's a good financing mechanism, and that is why whenever the operation is really high, then they would wish to generate that huge an amount, and that huge an amount is possible through the stock market, not otherwise. But when we come to secondary market, the money doesn't go to the company. So company has issued the security, say for example, at 127 rupees or 100 rupees as a capital, and security premium as 27 rupees. But now the company doesn't have any involvement. Now the shares would belong to the investors, right? Here in this case, say for example, if Harkiran, she has certain amount of the shareholding in the company. If she wished to sell, say for example, at 180 rupees, which is a market price at that point in time to me, then I will have to pay 180 rupees. This 180 rupees will go to the bank account of Harkiran and not in the bank account of company. Company doesn't have any claim over this amount, the amount which is generated in the secondary market. So in secondary market, whatever, if Harkiran has purchased the security, say for example, for 127 rupees, and she has sold the security at 187 rupees, then the difference of 60 rupees, this will be her profit. So this is capital appreciation for the investor. And over a period of time, if the company declares dividend, then dividend would also belong to Harkiran, because she was the member on the record date. So company specify the record date, and on the record date, whoever is a member in the register of members, they are the one who would derive the benefit of these corporate actions. Corporate action means anything which would materially impact the company. So dividend, merger and amalgamations, and lot many other things. Say for example, when you bifurcate the share valuation, everything, it would come under the definition of corporate action. The common example of corporate action is dividend, or when you declare the bonus share, or say for example, when you go for the right issue. These are very common ways of examples of corporate actions. So this is another difference. Third difference is organizational difference. As I have mentioned, that primary market, there is no physical space of primary market. There's nowhere you cannot, like, geographically, you cannot, or physically, you cannot pinpoint that this is a primary market. That market exists, but in a very much intangible form. You cannot touch it. Just like you could utilize it, but you cannot, like, locate it on a map of India or map of world. You can never do that. But when we talk about other secondary market, there's a physical location, right? Though it's another thing that we execute trade online. If we have like Zerodha account, or say for example Motilal Oswal account, or say for example ICICI Securities or HDFC or SBI Security, if we hold the trading account, demat account, then in that case we can trade directly. We don't need to go there. But still, like in BSE and NSE and other stock exchange, there's a ring which is called as option ring, and you could also, like, go there and purchase the security and sell the security. And please also understand that purchase and sales in the security, it is not necessary that it will be routed through the stock exchange. So the law says that when you want to purchase a security through online mechanism, you cannot directly interact with the stock exchange. There is someone who are called as representative or agent of the stock exchange, and we know them by the name broker or sub-broker. So you cannot directly interact with BSE or NSE. You need to go to the broker to purchase the security or sell the security. Similarly, depository, you cannot, like, we have NSDL and CDSL, two depository, but you cannot directly go to them. You have to go to them through another agent, which is called as depository participant. You cannot directly approach CDSL or NSDL. These are way to do that. So coming back, so now we understand that if you want to purchase the security, then how it will be purchased, through what platform, through what manner it will be purchased. There's still like something called off-market trade. So off-market trade is when you do not utilize the mechanism of the stock exchange. You do not utilize the mechanism of the broker to directly deal with another party. This is very common. Say, for example, if this transmission of the shares, or say, for example, if the transfer is between someone who is promoter and between the other party who wish to become the promoter of the company subsequently. So these shares at a particular price, it cannot be offered through the mechanism of stock exchange, because stock exchange, you never know who is the other party. The counterparty is the stock exchange itself, right? So we sell the securities to the stock exchange, we buy the security from the stock exchange. I would never know like who you are, if we execute the trade through the stock exchange mechanism. So many a times when a bulk trade, or bulk dealing in the security happens, generally it would happen through the mechanism of off-market thing. So, but in that case, problem is just one, and that is you need to pay the stamp duty. If you route the transaction through the stock exchange, you don't need to pay anything, just like broker charge and depository charge, just two charges, right? But if you route the trade through off-market trade, then in that case, you need to pay the depository charge, because securities will be debited or credited from your depository account. At the same time, you need to pay the stamp duty, which is otherwise not payable. Right? This is the difference what we should keep in our mind. Having said this, we should also understand that there are a lot of similarities between NIA market and primary market and the secondary market, because primary market and secondary market, they belong to the same market, right? That is securities market, just two component of securities market. So they are susceptible. They're susceptible to the same influences, right? So there are a lot of similarities. First similarity is, say, for example, stock exchange listing. So stock exchange, it is a player in the secondary market and not in the primary market. But security, when it will be issued, it needs to be listed on the stock exchange. This is quite clear that it has to be listed on the stock exchange. That's why people go and offer the securities in the primary market. In the primary market, unless you want to offer the securities to the close connection and all that. If not that, then the main idea is to issue the securities in primary market and get the listing in the secondary market, right? So if we know that secondary market is the place where securities would be listed subsequently, the stock exchange, they play a very important role. And that is why ICDR says that when you have to come up with a security, issuance of the security, first of all, you need to go and take the in principle approval of the stock exchange, in principle approval of the stock exchange, right? So if you have not taken in principle approval of the stock exchange, you cannot issue the securities in the primary market, right? So first of all, you need to do that. Now, question is why stock exchange will give you in principle approval, unless and until the stock exchange understand that you are compliant with the law, or you will comply all the law which would be applicable in future, including ICDR and LODR. LODR talks about listing obligations on continuous basis, right? So if unless and until you comply already with those regulations, because it would happen just in a click of second. So securities are issued and subsequently maybe within some hours it would be listed on the stock exchange. So, and the whole process, it might consume a lot of time, maybe 3 months or 4 months or 5 months to get the process, correct. So IPO also, like, that's why we also call IPO as a process which paves path, for listing of the securities on the stock exchange. So that path has already, being constructed. So say, for example, if you enter into Jindal, then that's a gate. The moment you cross the gate, you will enter in our campus, what is visible in Harkiran's background. But there is a road, you need to travel on that road, say for example, from Delhi or somewhere, and then like there would be a point in time when you will enter it. So similarly, securities IPO, this paves the path for listing of the security subsequently. So stock exchanges, they need to ensure that everything is correct, everything is fine, you have all the system in place, all you're well compliant with all the laws, or you will comply with all the laws because you have capacity and intention to do that. Then only they will give the what do you say, a certain in principle approval. Otherwise they would not give you the in principle approval. That is something you need to understand. So and this listing, this is also beneficial. This idea of listing, this is also beneficial for the investor. So if you all, say for example, if you understand that my securities will be subsequently listed, you also understand that how easier it would be to transfer the securities in the name of someone else, right? So this very idea, it gives you psychological advantage. Otherwise, it would be a biggest psychological barrier, for you to move ahead and invest in any security. That, whenever securities price would go down, you could simply by click of a button, you could sell the securities or purchase the security. That's the biggest, satisfaction and safeguard for the investor. Exit option. So exit option, this is one of the pillar. This is one of the most beautiful pillar also in the corporate governance, and biggest right which has been granted to the investors. And these rights are, I would not say like prohibitive in case of private limited company or closed public limited company, but a lot of restrictions could be put in context of private limited company or public limited company. But shares are truly transferable, or securities are truly transferable if it is listed on the stock exchange. This is the beauty of the stock exchange, which empowers the investors community. So that is also why an investor would go forward and they would like purchase the security in the secondary market, in the primary market, because they know that there's a secondary market. If this idea would not have been there, then it would have been very much problematic. The next similarity is the very idea of control. So we understand that since the stock market, they have to come into the picture subsequently. So they start exercising control over the company from like, couple of months before actual, offering of the securities in the primary market. They have to do that. And especially when someone comes to you for asking for in principle approval, you need to start exercising control, because if you do not, stock exchanges, if they do not exercise the control, then it would be very much difficult subsequently to do that. Otherwise, investor would lose faith in the market. And this is the biggest, worry of all the regulators, government of any country, right? So they cannot, this faith in the stock market, this is very, very necessary, and it cannot be waived with. So that's the control element, which is again a similarity. Another similarity is economic interdependence. Both markets are economically related. Say for example, there has been a lot of evidence which would say that if the market is bullish means when the market is going up, and bearish means when it is coming down. You might have seen in movies, there's beer cartel, right? In 1992 scam, there was beer cartel. So beer cartel would drag the market down, and a bull cartel, they would drag the market up. So Harshad Mehta, he belonged to the bull cartel, and the another one, I'm forgetting the name, he belonged to the beer cartel. He wanted to pull the market down. So if the market is bullish, then in that case, the activity in the primary market would also increase. Getting my point? So if secondary market is bullish, then the number of offerings in the primary market, it would increase, and vice versa. So if the market is bearish, no one would take chance to come to the market. And so our market, say for example, our Indian market is so bullish that even in COVID time, there were a lot of IPOs, which has happened. And it was a surprise for most of the financial pundits, because they thought that it would be undersubscribed or not subscribed. But our market was, it was reverberating even in COVID time. And a lot of people, they were surprised that IPOs, they were getting oversubscription even in COVID time, right? So there is an economic interdependence. So if the secondary market is bullish, then a lot of activities in the primary market. And if the secondary market is bearish, then the market in the primary market also, it decreases, right? So this was the similarity and the differences. Now, another point which I needed to discuss is function of the secondary market and then primary market. In secondary market, generally, as I have told, that dealing in the security happens. Like securities will be sold, securities will be purchased, and this is exactly what. So it provides a continuous auction market, like auctioning. You have seen the movies, like, right? 1 lakh rupees 1 lakh rupees 2, 1 lakh rupees 3. So this is also an auction market wherein the price are discovered on a continuous basis. And price in the securities market, stock through the stock exchange, it is never fixed by the regulator. So prices will be fixed in the case of, say, for example, when the companies wish to go for the IPO, or company wish to go for the FPO, or when the company would go for the, say, for example, right issue or issuance of the security, whatever, the prices are fixed. But while trading, the prices cannot be fixed by the regulator. Prices are discovered through the market mechanism. economic principle of demand and supply. If the demand is more, then the price would go up. If the demand gets down, then the price would also come down. If the supply increases and demand remain stagnant, then in that case the stock price would come down, and vice versa. So prices are discovered through this auction. There's no one with hammer anywhere, but automatically. So you will see suddenly the prices of a particular stock is rising, prices of a particular stock is it is getting down. Government doesn't have any function, regulator doesn't have any function to fix that price, but they have to ensure, as a regulator, they have to ensure that there is no market manipulation. If there's market manipulation, and because of market manipulation, if the prices are going up or down, then they would intervene. They would come into the picture, and they will take the action. Otherwise they would not take any action, right? So basically, when we talk about securities market, basically, their functions are manifold, but most of the important function is, first is nexus between saving and investment. They channelize the money from our pocket, from the retail investors pocket, from institutional investors pocket. So if we have faith in the market, basically we would pump in money, our hard saved money, in the stock market. If not, then why someone would invest the hard? If I work very hard throughout the month, getting the salary, why I would take the chance of investing in the securities market, right? So this is a secondary market. This is a place where this money is channelized from the pocket of investors, and it would go to meet the need of the company, right? So company need money, and unless and until there are robustness in this market, the company would not flourish, the company would not prosper, new project would not start, new because the limited liability concept, this is the biggest concept. On the strength of this concept, some proprietor or some entrepreneur, they will take a chance to do something which otherwise they would not do, putting their the personal property on as a security, as a collateral, to get the loan, right? So the innovations, or say for example this ideas, it would not prosper unless and until these kind of companies with limited liability, they come and they take the chance. All the companies, they have taken the chance. Swiggy has taken the chance. Zomato has taken the chance. There are very few companies who were already established, and then they have ventured into the market. So this is the market which provides them with a much needed money, with a much needed fund, and this is very much possible through this market itself, secondary market. So the primary function of secondary market, the most important one, is channelizing of the money. Second is, it provides a marketplace of constant auctioning of the shares. Anyone can come, anyone can purchase the securities, anyone can sell the security, and lot of securities in large volume, it is being traded on a day-to-day basis in context of a company. Promoter would not trade in the securities most of the time. Maybe institutional investors would hold on the security for a long period of time, but retail investors, they do a lot of trading, and there are a lot of other investors who would do intraday trading. I'm totally against it, but anyway, they would do, and a lot of fluctuations in the share price, up, down, and all that. So what I want to say is, this is the other function of the stock exchange. They provide this marketplace, and because of this marketplace, a lot of people come and invest in the shares. The third is, already we have discussed, it provides a continuous price formation. So continuous price formation happens in the market. So every second, the prices of security would be different. It would depend on demand and supply concept. Demand increases, then security price would go up. So by every click of a button on the trading account of someone, it would have impact upon the share price. So share price are continuously being discovered. So even if you hold securities and you're holding it since last 1 year, or if you will hold the security for another period of 1 year, at least at every exact point in time what is the price of that security. The same thing doesn't go with, say for example, if you have owned the houses, the prices are not constantly being formed, but in stock exchanges these things are constantly formed. Now, functions of primary market, already I've said this, that the main function is the money which is needed by the company. They get the money through the primary market, NIM, right, which would not have otherwise been possible. So basically, the much needed fund of the company, it is being derived from the primary market. In the secondary market, whatever, if the market is bullish, it would help someone some company to come in the market for the first time and raise the money. But this appreciation in the capital, it would not benefit the company, but it would benefit the what is it, the investors. So investors are the primary focus of the secondary market, but primary focus in the primary market is, you understand, right? The company itself. So now another leg of discussion is, we have discussed about investors. We have also discussed that this market is very necessary, right? So market manipulations, it is strictly known. If there is a market manipulation, investor will lose confidence, and no one would dare, either they are domestic investors or say, for example, they are foreign investor, they would not come to India to pump in the money in the companies. They would never do that. So sanctity of market, it is very, very necessary. And that is why here comes the lawmaker. Lawmaker have come into the picture, and they have come up with a lot of laws. So as I have mentioned that, BSc, it's a very old institution. NSC, this is comparatively, it is a very, very new organization. If you like, most of the stock exchanges, they are not functioning now, and the reason is because SEBI has come up with with a scheme which says that if you are not if you are a mutual organization and not a corporate entity, you cannot function as a stock exchange. So most of the stock exchanges earlier, they were mutual organization, like partnership kind of thing, and they have to convert into corporate form. They cannot remain as a mutual organization. It needs to be a body corporate, right? Earlier, you will be surprised to know that BSc, say for example, at a particular place in Bombay, there was a banyan tree, and some stockbroker, they gathered together and they started trading in the securities under that banyan tree. Similar story goes with Kolkata, say for example, Kolkata Stock Exchange. There was a neem tree. Just imagine, not even shade, right? Just a neem tree, and the broker, they assembled together. They are under the neem tree, and they have started trading in the security. This was a thing that was a mutual organization, and most of the regulation, it were mutually discussed and agreed between a stockbroker. But as the trade grew, government thought that no, we have to come into the picture and we have to regulate everything. So they have started regulating everything. So primarily, these regulations are there are a lot of regulations, and but if I have to divide it into the main three part, act wise, enactment wise, then I could divide into three part, which is, first is Securities Contract Regulation Act. So basically, it was passed in 1956, a few years after our independence. So Securities Contract Regulation Act, this act has come into the picture because of two most important reasons. First is they wanted to regulate the stock exchange itself. At that point in time, stock exchanges were mutual organization. Very few were in the form of company. Most of the stock exchanges, they were in mutual form. So they come into the picture and they said that now we have to regulate it because a lot of trade and is happening, chances of fraud and a loss of public confidence. It is at a very high stake, and that's why regulation is necessary. And they came up with Securities Contract Regulation Act. This is primarily an act to regulate, like in order to act as a stock exchange, how you will go forward with it, how application would be moved, what fees needed to be paid, what is the registration process, how certificate will be issued for conducting these businesses, and thereafter regulation of the stock exchange. That was the first function of Securities Contract Regulation Act. Another function of Securities Contract Regulation Act was to regulate this contract in securities. So contract in securities means if you have purchased, if you need to purchase the security, if you need to sell the security, everything is contract, right? Even if if you go to the vegetable market and you purchase, say for example, potatoes or tomatoes, 1 kg, that's a contract, because contract could be an oral contract, it could be a written contract, right? So you cannot say that this is not a contract. On a daily basis, you execute a lot of contract. The moment you purchase something from Amazon or Myntra or anywhere, you execute a contract, and the essentials of the contract, it is very well present there, and it is regulated by Indian Contract Act, and you will realize it when you need to enforce it. Can you enforce it? Yes, you can enforce it, right? So element of contract, it is present. So that contract in securities, it needs to be regulated so that stock exchanges, they will not take undue advantage of the purchaser in the security or seller in the security. So this is one of the most important act, and this act also discusses about the public shareholding through SCRR, Securities Contract Regulation Act, right? So this is one of the principal act. Another act is SEBI, and most of you know about Securities Security Exchange Board of India Act, right? It was passed in year 1992. Again, 1992 was also a year when Harshad Mehta scam was, it has come into the light. So SEBI, basically, it has come into the picture, I think, in 1988 or 89, right? But that was an organization without any tooth, right? So that was an organization that was acting as a watchdog, but couldn't do much because power has not been given to them, and subsequently Harshad Mehta scam happened. And Harshad, throughout 1980s, a lot of scam used to happen, but Harshad Mehta scam changed everything, and the reason is just politicians were involved, and to the highest order, like even Prime Minister office, it was involved in this transactions. So it has changed in a very hurried manner. They came up with an ordinance, and through the ordinance, Security Exchange Board of India has come into the picture, and subsequently Act was passed in a parliament. Just imagine how in a hurried manner, because they have to say to the world that we need to change everything. We need to empower SEBI so as to not come clean, but at least like to show to encourage credibility of the investors. This is why SEBI has come into the picture, and over a period of time SEBI has garnered so much of power. So of course the main objective is they have to preserve the sanctity of the market. They have to work in the best interest of the investors, because investors, if they loses faith, then in that case it would be very much problematic thing. And for that they have come up with lot of rules. Rules is prerogative of central government. A lot of regulations, they come up with circulars, master circulars, guidelines, different regulations. If you go on the website of SEBI under the legal provision, under the legal tab, you will come across a lot of regulations, right? And I think all of you, as a student of corporate law, if you are interested in security law, you should go and try to open those documents and understand what are the functions and these things. So SEBI, basically, they have come into the picture and to protect the interest of the investor, and at the same, and for that they needed power. So a lot of powers has been given, including power to start the investigations against any party, including power to go for the adjudication, pass an order, including the power to give the direction to the different stakeholder, including the power to levy the penalty if someone is found as a wrong person. They have also the power to establish adjudicating body. Popularly, it is called as Securities Appellate Tribunal, ACT, which is at par with High Court of any state, because appeal is directly preferred to Supreme Court of India from ACT. So SEBI, they had been given so much of power, and more powers are being given, and that is why you must have gone through Nirmala Sitharaman's statement in the budget speech in 2021, when she said that we want to come up with a code on securities. Code on security, this is a long pending demand, because since there are a lot of laws and regulation, we wanted to combine it so as to provide more clarity, ease of doing business, less compliance burden, and a lot of other benefits are there. Liberal also, we came up with 4 codes, and basically we have combined all 30 plus 40 plus laws in 4 different codes. Similarly, in securities market also, for ease of doing business or whatever we wanted. But another reason was, over a period of time, courts, even Supreme Court of India, they had to come up and clarify certain instances. Say, for example, SEBI regulate the listed company. Listed company could be insurance company, also insurance company but listed. Or say, for example, it could they could come into the picture to regulate government securities, but government securities, RBI has power to regulate government securities, right? So this idea of coming up with a code which would include Securities Contract Regulation Act, Government Securities Securities Regulation Securities Act, or SEBI's Act, or say, for example, Depository Act, it's a huge step. It's a huge step. Let's see exactly what would be the modalities and how the things will be pan out in future. But coming back, so SEBI has huge power. And the third important, the party is the depository. So we have Depository Act. We understand that, we have bank account, right? With HDFC, with SBI. So banks, basically, they deal in funds. So if you want to receive the fund, or if you want to pay the fund, then in that case, you do it through the mechanism of a stock exchange. But when this, the things involved with securities, security is a very wide term. Security is defined in two places, one under company law and another is under Securities Contract Regulation Act. And the definition under Securities Contract Regulation Act, it's really a wide definition. So all the securities could be listed on the stock exchange, all the security could be dematerialized, and it could be traded through the intervention of depository. So depository, basically, it is like a bank. Depository, it's a bank, but it doesn't deal in the fund. It doesn't deal in the money. It will deal in securities. It will deal in the securities. All of you, if you want, you can get the account open. And once the account is open, you can purchase the security, and the securities will be credited in your account. If you sell the securities, securities will be debited from your account. So they also, like this intermediary, it also need regulation, right? So that is why SEBI, central government in 1996, they came up with this act for the regulation of depository. Along with it, there are a lot of other regulations. Some regulations are for regulating the issuance and for listing of the securities. Say, for example, ICDR regulation or LODR regulations, or say, for example, SEBI share-based employees benefit and sweat equity regulations, or buyback of securities regulations, PIT regulation, prohibition of insider trading regulation, takeover code, substantial acquisition of shares, and takeover regulation. There are a lot of regulations which governs basically the issuance of the security and listing of the security. Another place where intermediaries also, they need regulations. So there are a lot of intermediary. Say, for example, stockbroker, they need regulations, and for that we have SEBI stockbroker regulations. We have debenture trustee regulations. We have already we have discussed about depository. They are also like intermediaries. They need regulations. These registrar to the issue and transfer agent, they also need regulations. Merchant bankers, they also need regulations, right? So all the intermediate, there are a lot of intermediaries. Say, for example, custodians or mutual fund or foreign venture capital or alternative investment fund. So all the intermediaries, they need some sort of regulations, and SEBI over a period of time, they have come up with different set of regulation. You'll find the list of all the regulations on SEBI's website. So kindly go there and try to read about it. Also, like there are other regulations for regulating, say, for example, mutual fund or collective investment schemes, or say, for example, ombudsman. They also like need to be regulated, or a portfolio manager, especially foreign portfolio manager, they need to be regulated. So these regulations also, it has been passed. So this is a long journey. So I'm just like, I'm discussing with you to generate enough, interest so that you become a student of securities law. This is a long journey, and this was just the beginning of that journey. Now I'm open to questions because I'm already exceeding the time.
Yes, Professor, we have a question from Shrey. So his question is, how is unsponsored depository receipts different from stocks?
See, depository receipt is, when we say stocks, stocks are securities, right? So securities, as I have mentioned, that there are wide definition of securities. Equity could be one kind of security. Debt could be another kind of security. ADR, GDR, this could be another kind of securities. Even under securitization law, if there is a securitized receipt, again, this is kind of it is one kind of securities. So securities definition is very wide, and one of the definition of security is stock. And normally when we say stock means equity stock, right? Not otherwise. There could be debt, there could be debenture, there could be other deposit certificates, there could be government certificates. Say, for example, government securities and all that. So when someone issues the depository receipt, and this is exactly your question is, so depository receipt, this is simply an evidence of that order has been received, instruction has been received. Whenever they will receive the information from clearing corporation, basically clearing corporation is who clear and settle the trade. So whenever they will intimate the information, they will receive the intimation from the clearing corporation, then accordingly they will let the holder of the security, holder of their account know about it. These days, depository, it is highly regulated. So we have like, and depository, you should understand this, that depository and depository participant, they come under the definition of intermediaries under section 12 of Security Exchange Board of India Act. So unsponsored, it's highly regulated, and there are just two depository, NSDL and CDSL, which is highly regulated by Depository Act, regulated by depository regulations, regulated by their own business laws and bylaws, which bylaws need to be approved by Security Exchange Board of India. So unsponsored, this would be difficult. I've not read the whole question, I'm sorry. Context NSE I see in news, and also NSE IFC is different from companies like India Money. See, please understand that when you refer to NSE or NSE IFC, these may be stock exchanges, right? But when you refer to companies are either issuer company, or if they facilitate these transactions, then in that case they have taken the license of broker or sub broker, right? So IND Money or Winvesta, etc. I'm not like I have heard about IND Money and all that. They might have taken the license as a sub stockbroker from as an intermediary from Security Exchange Board of India. Otherwise, they cannot deal in the securities. But you're getting my point. So NSE, IFSC, this is a stock exchange, and IND Money and all that, they might have taken the licenses to operate as a broker. Otherwise, they could not operate as a broker. And at the same time, who deals in the US stock. So in US, as per SEC law, they might have taken the license in that location. Otherwise, because throughout the world, these functionalities are highly regulated. They cannot like simply, gather the money and they would invest the money somewhere. If they are channelizing the money, and for the purpose of the US stock exchange, they must get registered. This is my view. They must get registered and under SEC regulation. Yes, Shrey? Any other question? IND Money, I think that guy, what's the name? Wadiku. What's the name? ISB guy who has written book also, and I think he is promoting this. Ankur Wadiku. Yes, absolutely, Shay. Thank you. Any other question?
We're now open to questions. Any other questions?
So Shay, just for your purpose, if you just Google registered stock exchanges in India, you can find the list of it. I think there are 7-8 stock exchanges. You find it on the website of SEBI, and you'll get the list. So kindly find out if this stock exchange you are talking about. I think I've read it. I have taught it in the class. So this is one of the stock exchange. No other questions?
Thank you, Professor Singh, for your time. It was an interesting lecture. How beautifully you explained the fundamental concepts of security regulations in India, and how you clearly differentiated and explained the similarities between the primary market and the secondary market. It was really a very interesting lecture. Thank you.
So it was because most of the people are not aware of securities market. I could not have gone into the technicalities, but I wanted to touch law also. Thank you very much, all of you, for listening me, and thank you, Harkiran and IT team, to facilitate this session. Thank you very much.